Your parents were not wrong. They did everything right. House by 32, retirement account by 35, car paid off by 40. They followed the rules. And for a while, it worked. But here is what nobody told you when they handed you that same playbook. The economy those rules were written for no longer exists. The interest rates are different. The housing market is different. The job market is different. The cost of everything is different. And the people who are winning financially in their 30s right now are not following their parents' advice. They are breaking it. Today, I'm going to show you exactly why the traditional 30s financial playbook is quietly draining the people who follow it. And I'm going to show you what the people building real wealth in their 30s are doing instead. This is not about blaming your parents. This is not about rejecting everything you were taught. This is about understanding that the map changed and nobody updated the directions. By the end of this video, you will know the 5 financial traps hiding inside advice that sounds completely responsible, and you will have a clear picture of what to build instead. Let me paint a picture. You are in your 30s, maybe early 30s, maybe pushing 38. You have a job, a decent one. You are contributing to your 401k. You might have a car payment. You are thinking about buying a house, or you already did. On paper, everything looks fine, but at the end of every month, the math feels tight. The savings are not growing the way you expected. The life you pictured at this age feels further away than it should. And the most frustrating part, you are doing everything right, everything they told you to do. So why does it feel like you are running in place? The answer is not that you are doing something wrong. The answer is that you are doing the right things for the wrong decade. Here is what happened to financial advice in America. The playbook most of us inherited was built in the 1970s, 80s, and 90s, a period of specific economic conditions that made certain moves almost automatically smart. Houses appreciated steadily. Inflation was manageable. One income could support a family. Pension plans existed. College was affordable. Job security was real. In that economy, buy the house early, max the 401k, pay off debt, retire at 65. That sequence made complete sense. But the economy shifted. Housing prices tripled in real terms. Interest rates swung to extremes. Job tenure collapsed. Gig work exploded. Student debt became a generational burden. Healthcare costs became a financial variable nobody's parents had to plan for. The conditions changed completely. The advice did not. And that gap between the conditions the advice was built for and the conditions you are actually living in, that gap is exactly where the financial death trap lives. There are 5 specific traps. Each one sounds like responsibility. Each one is quietly costing you. Let me tell you about Jordan. Jordan did everything by the book. Graduated college at 22. Started a 401k at 24. By 31, Jordan had a decent job, a car payment, and bought a house in the suburbs with a 30-year mortgage because that is what you do. Jordan put 10% down. Mortgage payment was manageable. Life felt stable. But here is what happened over the next 5 years. The house needed a new roof, $12,000. The car needed replacing. Another car payment layered on top. Property taxes went up. HOA fees appeared that were not mentioned at closing. The neighborhood Jordan bought into started shifting, and the projected appreciation never materialized. By 36, Jordan had a mortgage, 2 car payments, a 401k that was growing slowly, and 0 liquid savings outside of a checking account that refilled and drained on the same cycle every month. On paper, Jordan had assets, a house, a retirement account, 2 vehicles. In practice, Jordan had no financial flexibility, no ability to take a risk, no ability to pivot, no ability to invest in anything outside the box the traditional playbook had built. Jordan is not a cautionary tale about bad decisions. Jordan is a cautionary tale about good decisions made in the wrong order for the wrong moment in history. And Jordan is not alone. Jordan is the majority. Here are the 5 traps and what to do instead. Trap 1. Buying a house because you are supposed to, not because the numbers work. The advice: buy a house as soon as you can afford one. Build equity. Stop throwing money away on rent. Why it was right then. In a low interest rate, steadily appreciating housing market, buying early almost always won. Why it is a trap now. A 7% mortgage on a $400 house is not building wealth. It is servicing debt. The first 10 years of a 30-year mortgage are almost entirely interest. You are not building equity, you are paying the bank. And the liquidity you give up, the down payment, the closing costs, the maintenance reserve, is capital that could be compounding elsewhere. What to do instead? Run the actual numbers before you buy. Compare your total monthly cost of ownership against renting the equivalent property. If renting is significantly cheaper, and in most major markets right now it is, the smart move is staying liquid and investing the difference. The goal is not to own a home. The goal is to build wealth. Sometimes those are the same thing. Right now in many markets they are not. Trap 2. Treating your 401k as your only wealth-building vehicle. The advice: max your 401k every year. Let compound interest do the work. Do not touch it until retirement. Why it was right then. The 401k was a genuine revolution in personal retirement savings. The tax advantage is real. The employer match is free money. Why it is a trap now. The 401k locks your money until 59 and a half. It limits your investment options to whatever your employer's plan offers. And it delays access to capital during the exact decades, your 30s and 40s, when investment opportunities and leverage opportunities are most available to you. What to do instead? Take the employer match always. That is a guaranteed return. But after the match, consider whether a Roth IRA, a brokerage account, or a real estate investment gives you better returns with more flexibility. The 401k should be one vehicle in a diversified approach, not the entire strategy. Trap 3. Paying off all debt before investing. The advice: get out of debt first. Debt is the enemy. Pay it all off before you build wealth. Why it was right then. In a high-interest debt environment, paying off debt was often the highest guaranteed return available. Why it is a trap now. Not all debt is equal. A 3% student loan in a market returning 10% annually is math that favors investing over paying off debt aggressively. The blanket advice to eliminate all debt before building assets costs people years of compound growth. What to do instead? Sort your debt by interest rate. Any debt above 7 or 8%, pay it down aggressively. Any debt below that threshold, make the minimum payment and redirect the rest toward investments that outperform the debt cost. Let the math make the decision, not the emotion. Trap 4. Optimizing for job security over income growth. The advice: find a stable job with good benefits and stay there. Loyalty is rewarded. Security is the goal. Why it was right then. In an economy with pensions and predictable career ladders, staying was often the highest return career move available. Why it is a trap now. The average raise at a company is 3%. The average raise from switching jobs is 10 to 20%. Benefits packages have eroded. Pensions are gone. Layoffs are routine even at stable companies. Job security as a long-term financial strategy is largely a myth in 2026. What to do instead? Treat your career as an asset you are actively managing. Every 2 to 3 years, ask whether staying is still the highest return option. Build skills that make you portable. Your income is the engine of every other financial move you make. Optimizing it is not disloyalty, it is strategy. Trap 5. Delaying investing until you feel ready. The advice: get stable first. Pay down debt. Build a solid foundation. Then invest. Why it was right then. In a world with fewer accessible investment vehicles, waiting for stability made sense. Why it is a trap now. Every year you delay investing in your 30s costs you compounding that cannot be recovered. A dollar invested at 30 is worth dramatically more at 65 than a dollar invested at 40. The foundation first mentality sounds responsible and costs people decades of growth. What to do instead? Start investing now. Even small amounts. The habit and the compounding matter more than the size of the initial investment. Done is better than perfect when it comes to starting. 5 traps. Each one disguised as responsibility. Each one inherited from a playbook written for a different world. I want to say something directly. Your parents gave you the best advice they had. They were not setting you up to fail. They were handing you the map that worked for them, the map that got them through. The problem is not the people who gave you the advice. The problem is that the terrain changed while the map stayed the same. You are not behind because you are bad with money. You are not struggling because you lack discipline. You are navigating a 2026 financial landscape with a 1990 map. And the people winning right now, the people in their 30s actually building wealth, are not smarter than you. They are not luckier than you. They just got an updated map earlier. You just got yours. The 30s are not a financial death trap if you know what you are actually navigating. They are the most important financial decade of your life. The decisions you make between 30 and 40 compound for the next 30 years. That means the cost of the wrong map is enormous, and so is the reward for getting the right one. Here is your updated framework. 5 moves for your 30s that the old playbook missed. 1. Run the actual numbers on home ownership before you buy. Rent is not throwing money away if the alternative costs you more and locks your capital. 2. Take the 401k match and then diversify. The 401k is one tool, not the whole toolbox. 3. Sort your debt by interest rate. Pay down aggressively above 7%. Invest the difference below it. 4. Treat your income as an asset. Optimize it actively. Switch jobs if the math demands it. 5. Start investing now, not when you feel ready. Now. That is the updated map. Not a rejection of everything your parents taught you. A recalibration for the world you are actually living in. But here is what I need you to think about before the next video. Everything we just talked about assumes one thing, that you are building toward ownership, toward assets, toward a home eventually. But what if that assumption itself is the trap? Right now across this country, people are renting instead of buying and coming out significantly ahead. Not because they cannot afford to buy, because they ran the numbers. The $400 house that everyone says you need. There is a case being made right now that it is one of the most expensive financial myths of 2026. That is the next video. If this changed how you think about the financial advice you inherited, subscribe, because the next one is going to challenge something even more deeply held than that.